In traditional 12-step programs, the second step is to acknowledge the presence of a higher power. Investors have a higher power. It's evidence. Rigorous, independent, peer-reviewed, time-tested evidence about how markets work and how to invest. That evidence has been compiled over many decades by a distinguished group of academics, many of them Nobel Prize winners. Broadly speaking, their findings can be summarized in three key concepts. The first concept investors need to grasp is the random walk. It dates back to 1900 when the French mathematician Louis Bachelier concluded that there is no useful information contained in historical price movements of securities. Future price movements, said Bachelier, were no more predictable than the steps of a drunkard. But it wasn't until the 1960s that academics acknowledged the significance of Bachelier's contribution, foremost among them the economist Paul Samuelson. His findings can be summarised as follows. Market prices are the best estimates of value. Price changes follow random patterns. And future news and hence stock prices are unpredictable. The notion of randomness was further developed in the 1970s by the economist and author Burton Malkiel. In his book, A Random Walk Down Wall Street, Malkiel famously wrote, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by the experts." Both Samuelson and Malkiel had a significant influence on Jack Bogle, the founder of the Vanguard Group, the firm that pioneered passive investing for individual investors.
The random walk hypothesis is really crucial for investors to understand. It in essence says that the current price includes all the information we currently know and actually the impact of that information on the future. So what that really says is now the change in price in the future has to do with new information that is random and unpredictable by definition. Nobody knows tomorrow's news. The recognition of this randomness of returns sort of eliminates the ability for investors to try to pick stocks and to try to time the market. And that's why it's so important that they understand the random walk hypothesis.
The second key concept underpinning passive investing is the efficient market hypothesis. In a paper published in 1965, Professor Eugene Farmer challenged the assumption that the resources available to professional fund managers enable them to outperform a randomly selected portfolio of securities with similar risk levels. His conclusion was that there was no outperformance beyond what you would expect through random chance. In another paper published 5 years later, Farmer concluded that equity markets consistently incorporate all available information into prices, and that trends in capital markets cannot be identified in advance. The only way an investor can expect to beat the market return is by taking risk greater than the market. His work on market efficiency later earned Farmer the Nobel Prize in Economics.
The efficient market hypothesis is one of the most challenged ideas in finance. And finally, in 2013, the Nobel Prize was given for it. Further evidence of its importance is the continued increase in the interest in an index fund. The index fund is actually born out of the idea that markets are efficient.
The third and final concept to consider is modern portfolio theory. It was developed by another Nobel Laureate, Professor Harry Markowitz. He showed that assets should be evaluated not only for their individual characteristics, but also for their combined effect on a portfolio as a whole. Reducing risk, Markowitz argued, was just as important as maximising return, and that requires having a diversified portfolio. Modern portfolio theory has evolved over time. In 1992, for example, Eugene Farmer and Kenneth French expanded on it with a paper on the different risk factors that drive market returns. As much as 96% of historical returns, they found, could be explained by exposure to market, size and value risk. The work of Farmer and French inspired David Booth and Rex Sinkerfield to found Dimensional Fund Advisors, a mutual fund company based in Austin, Texas, that's helping to revolutionize the way we invest.
The Farmer and French multi-factor model was a sort of evolution in the idea of indexing. We started off with just a broad general market based on the market capitalization of companies as sort of a starting point of indexing. Let's just buy the S&P 500 as an example. But as researchers continue to look at different characteristics or dimensions of companies, they realized that small companies, for example, had higher returns than large companies, and value companies had higher returns than growth companies. And so they started moving to the idea that you could construct portfolios, diversified portfolios, with those factors weighted into those particular companies in that particular index, and actually end up with portfolios that are of slight higher returns than the broad market capitalization weighted portfolio.
Of course, it's not essential to understand the finer details of the random walk, the efficient market hypothesis, or modern portfolio theory to be a successful investor. But if you're going to have a passive investment strategy and stick to it, you need to understand why you're doing it. To summarize, markets are broadly efficient. All known information is already incorporated in the price of each security. Markets react to new information, which by its nature is unpredictable. Markets are prone to periods of volatility, but over the long term, they will reward investors for the risk they take. Finally, the most effective way to reduce risk is through diversification. The rational approach then is to invest for a very long time in a highly diversified portfolio and to resist any temptation to change course.